Hello and welcome to the Global View on this Friday. I'm Andrew Gagan. Good to have you with us again here at AusBiz. Let's begin in London. Rio Tinto abandoning talks to acquire Glencore, the proposed $374.5 billion merger that would have created the world's largest mining group. Rio is saying in a statement it had determined that it could not reach an agreement that would deliver value to its shareholders, while Glencore said the proposal significantly undervalued its business, including its copper assets, and opposed Rio's plan to retain both the chair and chief executive roles. Glencore shares falling 7%, while US-listed Rio shares also finishing flat. Well, global investor sentiment soured further overnight with losses across the board of major bourses, while precious metals fell, Bitcoin plunging. On Wall Street, shares of US software and data services companies extended their steep slide for a seventh straight session on investor concern that rapidly developing AI tools could disrupt the sector, and NASDAQ falling to its lowest level in 3 months. Well, shares of Alphabet fell after the Google parent said it plans as much as $185 billion in capex this year. Together, it and big tech rivals are expected to collectively shell out more than $500 billion in AI this year. Adding to recent losses, Microsoft dropped, along with Palantir and Oracle, while shares of Nvidia, which stands to benefit from increased industry spending on AI, was also lower. Amazon shares tumbled more than 10% in after-hours trade when it delivered quarterly results. The world's largest cloud services provider, expecting to invest about $200 billion in capex in 2026, compared with initial market forecasts of $144 billion. Atlassian reported revenue of $1.6 billion, up 23% on the year, a net loss of $42 million. Free cash flow, which its preferred measure of profitability, was at $168 million for the quarter. Software and data services stocks added to recent losses, including ServiceNow and Salesforce, while Qualcomm fell heavily after forecasting second quarter revenue and profit below estimates. And Snap topped fourth quarter revenue estimates, but its shares tumbled. Estee Lauder shares also plummeting, and Tapestry surging after raising its annual profit forecast, while Hershey came up with better than expected annual profit forecast. Well, the European Central Bank has left its benchmark key rate there at 2% as expected, with a largely unchanged inflation outlook, suggesting policy will remain steady for months to come. The Eurozone Central Bank has been on hold since ending a long run of cuts in June. And the Bank of England has also kept interest rates on hold at a narrow 5-4 vote, and said borrowing costs are likely to fall if inflation continues to decelerate, despite a big cut to its economic growth forecast this year, along with a rise in unemployment, the BOE leaving its benchmark rate at 3.75%. In the US, job openings fell to the lowest level in more than 5 years in December, and data for the prior month was revised lower, signalling a softening labour market, while jobless claims increased more than expected last week. US Treasury yields have fallen on the weaker than expected jobs numbers. The yield on the 2-year note falling almost 8 basis points to 3.48% the 10-year, down to 4.2%, the biggest drop in yield since October. And the US dollar has hit a 2-week high against most majors, while the British pound has tumbled, the Aussie trading at 69.3 US cents. And oil prices have fallen after the US and Iran agreed to hold talks in Oman later today. Brent crude futures down around 3% at $67 a barrel. Precious metals have fallen as a stronger US dollar prompted the liquidation of holdings. Gold down more than 3%, trading at around $4,800 an ounce. Silver, initially tumbling around 17%, has cut that back more recently to be at around $73. And Bitcoin plunging, its decline accelerating amid weakening risk sentiment, driven in part by a broad sell-off in tech shares. It's fallen around 7% to below 64,000, its lowest level since Donald Trump won the presidential election. Well, let's get across those market moves on Wall Street. Joining us, Dave Sekera, Morningstar's Chief US Market Strategist. Dave, welcome back. There is so much action to get across at the moment. Now, you just described what we just saw on that session as being a bit ugly. You're saying perhaps it's uglier than it looks at first blanch. What are we to make of that, and perhaps how investors are negotiating what they're seeing at the moment? Because you spoke about this likely increased volatility this year.
Yeah, I mean, we warned investors coming into the year, for a couple of different key reasons why we expected greater volatility this year as compared to 2025, and why we expect the volatility is going to last really throughout, the full year. And we're already seeing that play out here in January for a number of different reasons. Of course, the tech industry being the one where we're seeing the most volatility, whether that's in a lot of these, hyperscaler AI stocks or whether it's in the service stocks. But we're seeing it all across the market. In fact, when I look at the tape today, it was really an ugly close. I saw a lot of liquidation going into the close. That's never a good sign. And of course, then we had Amazon stock, selling off in the after hours as well. And it wasn't just the stock market, as you noted. We saw cryptos sell off. All the commodities are selling off. So definitely a lot of liquidation going on out there. The only safe havens I saw today were consumer defensive, specifically the staple stocks, the food and beverage stocks, and the utilities. Other than that, pretty much everything was in the red across my screens.
Dave, what do you make? There are certainly two big issues playing out at the moment. Certainly, investors unnerved by the amount of AI capex those hyperscalers are spending at the moment. And then, of course, you have the threat AI is posing to those legacy software firms.
Yeah, and I think there's a little bit of cognitive dissonance, going on in the market where people are trying to, hold two different thoughts at the same point in time. So we have, the big AI hyperscalers, those that are in the forefront of AI, those that would actually be the biggest beneficiaries of AI over time, as far as if you really are that worried about the service companies, the software companies, not being able to hold their business models over time because you expect everyone to do, all their software in-house, then those big hyperscaler stocks actually should be doing a lot better, as well as a lot of those hardware stocks. Conversely, our investment thesis is we still think there's a reason for all of those software companies to exist in the future. We think that AI is actually going to improve the economic value that they're going to be able to hold for clients. So we think that there's a lot of value in those software stocks today with as much as they've fallen. But wow, just wow, looking at these capex numbers, everyone was expecting to come in higher, but I don't think anyone expected these to come in just as high as they are. I mean, first we had Meta, 125 billion in AI capex, this year. Microsoft looks like it's running at about $100 billion run rate. Then we had Google come out saying that they're looking at 180 billion of capex. Just to put that in perspective, there's only actually it's less than 60 companies in the US with an equity market cap of 180 billion or more. And then this afternoon, hold my beer is what Amazon said, 200 billion in capex. So I was just writing down some numbers here before coming on the call. So in 2024, between the big five, hyperscalers, between Microsoft, Google, Amazon, Meta, and Oracle, 2024, 260 billion really on average between those five for capex. 2025 going up to 440 billion. We're now looking at over 700 billion in spending in 2026. That's almost a $300 billion increase this year as compared to last year.
Yeah, it's almost they're just trying to outdo each other, isn't it? Bid after bid there, of just how high they are willing to go. Dave, before we get to your stock picks, just take a look at that chart you've got in terms of Morningstar's price to fair value sector by sector. Talk us through that.
Mm-hmm. Yeah, there's actually a number of different interesting changes that we saw, over the past month since we came into the year. Yeah, energy had a very good month. This was a sector we've, advised people to make sure that even though it was out of favor last year, you want to keep that energy exposure. It was trading at a 10% discount at the beginning of the year. As much as it's gone up, it's now trading at a 3% premium. Communications also was undervalued coming into the year at about a 9% discount. At this point, it's less undervalued, but still at a 4% discount. Technology is actually more attractive now, trading at a 16% discount, was an 11% discount at the beginning of the year. Really two things going on there, and we're seeing a combination of increasing our fair values on a number of different stocks this year after earnings have come out. But of course, with all of the stock declines in software, it's made that sector look even more undervalued to us. The one to be most careful of is going to be consumer defensive. People are using Walmart as a safe haven, same with Costco. Both of those stocks have traded up quite significantly. They're a huge percentage of the consumer defensive by market cap. We think those stocks are just way overvalued. Walmart, for example, trades almost 50 times forward earnings. Just a crazy PE multiple for an everyday low price, provider. Basic materials becoming more overvalued. A lot of that with the gold names that had moved up, as much as they have over the last month. And then finally, a bit of a pullback in the financials. So that's now only a 2% premium as opposed to an 8% premium.
Well, let's now move to some of those stock picks while we have some time left. Dave, let's begin in the software sector now. Of course, so many of them sold off significantly. Where are you looking at the moment?
Yeah, so our tech analyst today, like his two best picks for software right now are going to be Microsoft. It's a 4-star rated stock. It's now trading at a 35% discount to fair value. So a lot of intrinsic value that we see for investors there. I just like how it has a good blend of both traditional as well as AI business lines. I think this can benefit from both sides of the trade there. That we think software will hold its value over time for clients, but at the same point in time, with Azure growing well into 30% per year, a lot of big tangible addressable market there. So we like Microsoft. And then among the real software providers, ServiceNow, 5-star rated stock, trades at only half of our fair value at this point in time with as much as it's fallen. And if you think about ServiceNow, I mean, that company was built to really be able to automate different tasks for their clients. They're the ones that are going to be able to use AI to the best degree to be able to do that automation for their clients. Compared to some of the other software stocks, I think they have more than the average of AI business now compared to some of their other competitors.
And just briefly in tech, I see you like Palo Alto.
I do. I mean, I've always been a big fan of investing in the cybersecurity industry. This is going to be my pick. It's probably the largest, widest economic moat of the cybersecurity providers. 4-star rated stock at a 30% discount. I don't think that this, industry is going to get disrupted by AI. If anything, artificial intelligence is going to make cybersecurity even that much more important going forward. So this is my pick. I think this, pullback on Palo Alto with all the other software stocks, it's really providing investors a good opportunity for an entry point.
Dave, terrific to get across all those very volatile market moves. Thanks for joining us on Morningstar.
All right, thank you.
Let's turn to the local market ahead of the open. Then we are expecting a significant drop when we get going. As you can see, SPY futures off 1 1/10%. That we focus again too on the precious metals, given those underlying commodity prices have fallen overnight. Also a number of results to get across today as well, including News Corp and REA Group. We'll get into that in a moment when we get into the open. Stay with us.